Ladies and gentlemen, a very good day to all of you, and thank you very much for making time to meet with us today. Our thanks also go to Pareto Securities for giving us this opportunity to present our company at this conference. My name is Kenneth Pereira. I'm the Managing Director and a member of the founding management team of Hibiscus Petroleum Berhad. I will be presenting our company today and providing you with the main details of our business in the following slides. As part of the formalities, I need to draw your attention to this disclaimer. Please do take a minute to read it at your leisure, as it contains some important statements that you may need to be aware of. My presentation starts with this overview of the company. Hibiscus Petroleum started life as a SPAC and was listed on the main market of Bursa Malaysia in July 2011. We were the first SPAC listing in Southeast Asia and the first listed pure-play E&P company on the Malaysian Stock Exchange. The company is a constituent of the FTSE for Good Bursa Malaysia Index. The Malaysian Stock Exchange has 763 main market listed companies, but only 76 companies currently qualify as constituents of the index. The UK-based FTSE for Good team audit all companies on Bursa Malaysia once a year. After their last audit conducted earlier this year, we were placed as a top quartile constituent with a 4-star out of 4-star rating. We are also a company pursuing initiatives related to the energy transition. As we are operating in the UK North Sea, we have aligned ourselves with the legal commitment made by the UK government for Great Britain to be a net zero carbon emitter by 2050. In Malaysia, the national oil company Petronas has also set a similar timeline for its achievement of net zero targets. So our goals are now consistent with the objectives of Petronas as well. As a public company, we have more than 25,000 shareholders, a market capitalization of just over $300 million, and net assets of about $357 million. Throughout the last 10 years, we have mostly operated our company with no debt. As far as our issued securities are concerned, they are Sharia compliant. On the top right of the slide, we present some information about our shareholder base. As you would note, it is well spread. Unlike what is customary in the Asia-Pacific region, we do not have a controlling shareholder. In our case, the management team holds the largest block with about 9% of our issued equity. Only 2 other shareholders hold more than 5% of the issued shares, whilst our retail investors hold just over 40%. Finally, a combination of local and international institutional shareholders own about 37% of our equity. So we are truly a public company. Today, our asset base comprises producing oil and gas fields located in Malaysia and in the UK North Sea. We have also development assets in the UK continental shelf, Malaysia, and in the Bass Strait of Australia. Our strong performance in carrying out operations on our midlife production assets, both in the UKCS and Malaysia, has resulted in us being recognized with multiple awards for safety, drilling, and general operational performance. Moving across to the bottom right-hand corner of this slide, I'd like to provide some highlights of a recent acquisition that we made. On the 1st of June this year, one of our wholly owned subsidiaries acquired all of Repsol Exploracion's interest in its operated and producing oil and gas fields in Malaysia. As part of the same transaction, we also acquired an interest in a small producing asset located in Vietnamese waters. I will be providing some more details on our Repsol transaction, which is pending certain regulatory approvals in subsequent slides. Therefore, in the interest of time, I will not refer to the specific deal metrics presented in this slide, and instead I shall provide some more details on the Repsol transaction as we progress through this presentation. This slide presents some of the key points about the recent acquisition we made of the Repsol producing assets located in Malaysia and Vietnam. Over the next few minutes, I would like to highlight why we refer to this transaction as being transformational for our company. The graphs at the very top of the slide articulate most of the story. Our daily production rates will increase from about 8,000 barrels of oil equivalent per day to about 25,000 barrels of oil equivalent per day. This is almost a threefold increase in production. Our current proven and probable reserves base will increase by approximately 70%, from about 49 million barrels of oil equivalent currently to nearly 83 million barrels of oil equivalent. Our EBITDA levels will correspondingly also rise. Competent third parties forecast our EBITDA to increase from about $98 million this financial year to approximately $233 million for our next financial year. There are several other reasons why we like this asset. A recent third-party fair market valuation of the Repsol assets obtained from RPS Energy estimated them to be worth about $285 million. We secured them for a little over $212 million, so even before accounting for any benefit arising from a strengthening oil price environment and operational synergies that we may be able to implement, we have already seen some upside. Then there is the fact that these are proven fields that have been producing for over 20 years, since 1997 in fact, with current production supported by reserves just over 34 million barrels of oil equivalent in size. All of these certified by a reputable third party, again, this being RPS Energy. The long production history and the solid 2P reserve space combine to give us a high level of confidence that we have acquired a stable oil and gas asset that will deliver us value for some years to come. Furthermore, when we look at the production mix, we note that almost 50% of production from the Repsol assets comprises gas. Currently, only 3% of our production is gas, but post-completion of the Repsol transaction, we will have an opportunity to diversify into gas, and our gas output will increase to about 30% of our daily production. This will give us a more resilient production mix going forward. In addition, all this gas is sold to national oil companies of Malaysia and Vietnam, with the majority going to South Vietnam to fuel electricity generation, and is thus a critical energy resource for the area. We also believe that as a small company which will be operating a mid-size, mid-life asset currently owned by a large multinational company, we should be able to discover new opportunities to optimize costs and enhance production. Finally, and very importantly, this asset allows us to further strengthen our relationship with Petronas, and we also get a chance to initiate a business relationship with Petro Vietnam. This slide provides an overview of our portfolio of producing assets. You will notice it is a pro forma, which integrates information from the recent Repsol transaction. So you get to see what Hibiscus Petroleum could look like at completion of the Repsol transaction. As an aside, we hope to realize completion by the end of this calendar year, so it's not too long a wait. On completion of the transaction, we will have production in 3 countries: Malaysia, the United Kingdom, and Vietnam. All these countries have legal frameworks which are well understood by ourselves. In Malaysia and Vietnam, the fiscal regime is based around production arrangement contracts, sometimes called production sharing contracts, whilst in the UK, most of you would be aware that a tax royalty system is operative. A very key point to note is that we operate or jointly operate all the producing assets we currently have in our portfolio. And post completion of the Repsol transaction, this will remain to be the case. As mentioned previously, combined production from all our producing licenses will be about 25,000 barrels of oil equivalent per day. That is about 9 million barrels of oil equivalent per year. Currently, we are producing at about 3.5 million barrels of oil equivalent per annum. As also mentioned previously, our net proven and probable reserve space number from our producing assets add up to about 83 million barrels of oil equivalent. That equates to us having about 9 years visible production in hand from a 2P perspective. Drawing your attention now to the data shown in the pie charts at the bottom of the slide, you will note. On a proven and probable reserves basis, the first pie chart on the bottom left-hand of the slide shows that our 2P reserves will be reasonably equally distributed across the 3 producing assets in our portfolio. Moving to the pie chart in the middle of the slide, we note the importance of the Repsol assets to our production metrics, as almost 2/3 of our enhanced production base will come from the newly acquired fields. Our UK assets currently do not look meaningful as contributors to production, but we expect to invest in production enhancement opportunities in the UK North Sea in the coming months and years. This should result in an increased contribution from our UKCS assets post-2022. Looking at the final pie chart on the bottom right of the page, you will note that the Repsol assets will be a significant contributor to our EBITDA levels going forward. Whilst the Repsol assets are estimated to deliver about 2/3 of our production, they will only contribute to about 58% of our EBITDA because about half of the Repsol production is gas. This slide provides an overview of our portfolio of development opportunities. In terms of development opportunities, you will note that our proven and probable contingent resources base located in Australia, Malaysia, and the United Kingdom add up to a total of 74 million barrels. Let me say that it is at this time, we have no immediate plan to develop the Australian Vic L31 opportunity, but we continue to progress our UK development projects and our Malaysian opportunities. So again, a very strong base of discovered contingent resources to maintain or grow future production. However, final investment in the relevant projects will depend on the stability of future oil prices, projects meeting our internal investment criteria, and the availability of cash for investment into capital projects at the relevant time. Important to stress once again that we operate all the licenses in our development portfolio. As a footnote, I should say that we also have some exploration licenses, but I am not going to review these as exploration is not an area of focus at this time. On this slide, we present some key financial metrics. Before we get to the numbers, I wish to point out that as a company, we have always tried to operate with financial discipline, maintaining a conservative balance sheet. This has resulted in us having been virtually debt-free since our inception, always looking to recycle capital to fund operations and development projects. In 2018, a revolving credit facility was put in place with an oil offtaker to provide us access to liquidity in case any urgent requirement for cash arose. Occasionally, we draw on this prepayment facility. It is an $80 million line, but less than $10 million are drawn at this time, and even that balance will be settled in about a month. Referring to our M&A activity over the past 5 years, we have been involved in 4 transactions. In all cases, we acquired assets. When it comes to funding acquisitions, we realize that the size of our balance sheet does not permit us to win highly competitive deals when price alone is the deciding factor. So we selectively pursue transactions that allow us to deliver a compelling package to the vendor. This package would combine some cash with deferred and/or contingent consideration and some intangible components which we believe would be valued at a premium by the vendor. We are generally cautiously ambitious. We try to devise acquisition structures which allow us to do things larger than what we would be expected to do, but we are always mindful of the associated risks. As a company, we are very cash flow centric. When we consider building our portfolio through acquisition or we assess in-house production growth opportunities through the execution of projects, we always prioritize payback duration as one of the key investment criteria. Now on to some metrics. On the chart on the right of the slide, you will note some key financials covering the past 3 years. The chart presents our EBITDA, debt-EBITDA ratio, and our capital expenditure over the past 3 years. For a relatively small participant in this industry, we are reasonably pleased with our financial track record. As seen on the chart, the red columns demonstrate that we have managed to consistently deliver positive EBITDA levels. In addition, the yellow columns on the chart also show that we have not avoided executing capital projects on our assets, but once again, it is our strategy of being an asset operator that has allowed us to phase our capital expenditure program and thus avoid stressing our cash position. Also tabulated on this slide are some other key metrics. From an operational perspective, I would draw your attention to the average OPEX per barrel of oil equivalent number consistently achieved over the past 3 years of about $20. Whilst oil prices have fluctuated, sometimes quite wildly, it is this cost structure that has allowed us to deliver positive cash flows year on year and fund our capital projects with minimal or mostly no gearing. We are a relatively small IOC out of Asia, but we are pleased to be able to report that we have a long-term energy transition strategy in place. Our overarching aim of being a net zero emissions producer by 2050 has been recently encapsulated in our mission statement. This net zero objective aligns us with the UK government's legally binding target of being a net zero carbon emitter by 2050, as well as Petronas's own aspiration to be a net zero oil and gas producer also by 2050. The delivery of our mission is underpinned by 3 enablers, these being, firstly, the creation of a resilient portfolio of hydrocarbon assets. This includes increasing natural gas resources and reserves in our portfolio, as gas is the cleanest of fossil fuels and will continue to have an important role in the energy transition. In Southeast Asia, where the greater part of our business is trending towards, we see gas as an increasingly important component of the energy mix for the generation of electricity, gradually replacing coal. Secondly, we are seeking and implementing ways to gradually decarbonize our upstream operations. In developing a pathway towards being a net zero carbon emitter, we understand that it is inadequate just to declare a target for delivery by 2050 and then actually do very little. We need our targets to be underpinned by a realistic roadmap to get us there, and at this stage, we are currently engaging and seeking collaboration with key technology providers so that we can deliver on our commitment towards reducing our carbon footprint. I'm pleased to also be able to cite an example in this area. In Malaysia, on our North Sabah asset, we operate 20 offshore installations. 19 of them are unmanned. In these unmanned facilities, we have been switching the electricity source from diesel fuel generators to renewables such as solar and wind. We have invested in the installation of solar panels and mini wind turbine systems together with storage battery systems. The benefits have been rewarding. We have reduced diesel usage, reduced operational costs, and also reduced our carbon footprint. As another initiative, we are also exploring carbon capture and storage opportunities in order to achieve decarbonizing of our midlife assets. Finally, we recognize that investment opportunities in technologies that may complement the decarbonization of the oil and gas sector may arise from time to time. In this regard, our board has approved our set of investment criteria, and we are on the continual lookout in a structured but disciplined manner for such niche technologies. I need to stress our investment criteria only allows us to consider opportunities that are sustainable, profitable, and adjacent to our industry while leveraging on our existing capabilities. There are other components of our energy transition strategy, but to summarize, our strategy is long-term. It is a continuous journey that we have committed to at the highest level of our leadership. And we are putting in place the necessary building blocks in the area of sustainability to ensure that we will be regarded as a relevant and responsible player in our business sector in the foreseeable future. To close this presentation, I'd like to stress some key takeaways. Hibiscus Petroleum started life as a SPAC 10 years ago. 10 years on, we can say we have survived some of the toughest cycles seen in our industry for many decades, and we have come out stronger. We now have a portfolio of assets with producing fields in Malaysia and the UK North Sea, and our producing assets generate strong cash flows. After an international competitive bidding process, Hibiscus Petroleum was selected by Repsol to acquire their Malaysian and Block 46 Vietnam producing fields. The sales process culminated in June this year when we signed a conditional sale and purchase agreement with Repsol. Legal completion of this transaction is expected to take place by the end of the 2021 calendar year. Once completed, we believe this acquisition will be transformational for Hibiscus Petroleum, as we expect our oil, gas, and condensate production to almost triple to about 25,000 barrels of oil equivalent per day, with our 2P reserves increasing by about 70% from 49 million barrels of oil equivalent to about 83 million barrels of oil equivalent. In order to do our part to mitigate climate change, we are committed to our energy transition strategy. Overall, we are cognizant of various uncertainties caused by the continuing COVID-19 pandemic, but we remain focused on delivering optimal performance in an improving oil price environment. Thank you all for your attention, and once again, I would like to thank Pareto Securities for hosting us at this conference. If you do have any questions, feel free to contact us at the email address below. Thank you very much.